All right, for those of you joining via Zoom and LinkedIn Live, we welcome you to today's webinar. Today's topic is how to succeed in leasing and property management. So this is going to be based off my experience as a developer. Uh, all I've ever done is build property and then lease it. I've never bought something that's already been leased. And so, if you're looking for value add opportunities or just acquiring something that's already full and how to keep it, some of the content here will be relevant, but we'll have a few different takes too. Now, my background is in development. I've been doing this close to 10 years now. Started off buying and selling land for a profit, and then from there started building properties and so forth. So currently, I own about 400 units across different regions here in the United States. Most of these are larger multifamily to mid-size multifamily properties. My smallest is 44 units. My largest is 214 units. Done a lot of development through that 10-year period, and a lot of acquisitions. Now, with my experience here of developing uh, and owning units, I have a lot of experience working with property managers, and I can tell you from that experience that it does matter who you work with. It matters who you hire. Um, while you as a developer might live locally, you might live remotely from the property that you own. The property manager is the person that's on the site every single day, right? And you have your on-site manager and you have your support staff that may not be on site every day, but those are the people that know what's going on in real time. Um, there's a couple things to know in general with this selection process. First off, great management and poor management can sometimes look very similar when you're doing the interview process. There's subtle things that you need to look for and identify. Ultimately, a great manager is going to help you with faster lease up for your property, and faster lease up means reduced carry costs. So I have an expensive construction loan. Oftentimes is going to be between 10 and 12% on interest. Well, at 10 and 12%, I'm not going to be cash flowing on that property, even if it's completely full. Now, most long-term lenders will not refinance on the property, and most buyers don't want to buy it until it's reasonably stabilized or close to full. And so the longer it takes for you to get to that stabilized point for the property, the more expensive interest you're paying, and the longer it's going to take for you to be able to convert into a longer term, cheaper loan or sell the asset at a profit, etc. So fast lease up is important, and a great manager will help you to get to that point, and to make decisions along the way to help adjust if your goals are not being met. Higher effective rents. So, a great manager is going to help you be aggressive there within reason, right? Poor managers will give you the easiest rent possible for them to be successful. A great manager is going to understand that balance. They know, they look at things from a developer's perspective. They know when it's time to lower rents, but they also know the pain point that creates in the process, and so they're not trigger happy to do so. So for the most part, they're going to look at your comparables, and they're gonna recommend where you should be in relation to the comparable properties in an area, to be able to drive traffic, but also not miss out on rents that you could be collecting. Better tenants. So a good manager is going to help you to identify proper screening standards, and they're going to be the ones that either accept or turn away potential tenants. And so a good manager who's doing this effectively is going to help reduce turnover. Good tenants means tenants that are qualified to be there. They're not having to leave early, and oftentimes they're going to renew and stay for a long time. So lower turnover means better or less costs associated with turnover, and less legal fees with having to do evictions, less skip outs, etc. That's very important, especially over the last year. I've noticed delinquency is much higher than it has been historically. Skip outs happen a lot more, and so having those upfront screening tactics becomes very important. And lastly, a great manager is going to be efficient in their operations. This is going to be somebody who cares about the property, they care about the tenants, but they also care about the bottom line. You usually review and approve a budget with a manager, and good managers stick to that budget and they identify areas in that budget throughout the year that they can actually create savings for you. Now, whenever you have an efficient property, you're maximizing your NOI or net operating income. Now, net operating income ultimately is what determines how much money you're making on the property, but also what the valuation of that property is going to be. So when you go to sell it or you go to refinance, that valuation matters. If you don't get a proper valuation, sometimes a refinance might require you to bring more cash from you or your investors. Um, or if you go to sell it, you might not be getting the most proceeds that you can to be able to maximize your return and profits on the project. So NOI is really key here, and your property manager is the one that helps drive it. Poor managers are quite the opposite of what I just listed. So you're going to have oftentimes a slower lease up. They're just not going to have as much experience in that process, or if they have experience, um, if they're not on top of things, you're just not getting as much traffic. You're not converting that traffic at a high level. Heavy concessions, a lot of them will recommend unnecessary or heavy concessions to help them when in reality it's they can be on top of things, they can be converting better, etc. Um, Bad tenants, so poor screening standards leads to higher delinquency, higher turnover, which creates a lot of problems for these properties. And expense and efficiency, if they're not sticking to budget, if they're not caring about the contracts that they're signing and really trying to get the best price possible, all that leads to NOI leakage, sorry, which really impacts the value of your property. For every $1 in income that you either gain or lose on a property, that results in $20 in valuation either gained or lost. And so every dollar matters, and having a manager that knows that and cares about every dollar, uh, really, they're worth their weight in gold. And a manager who doesn't understand that, who doesn't care, it's going to create a lot of problems long term for your property. Okay. So how do we select and identify a good manager? Here's a few evaluation tactics to use. First off, experience is incredibly important. You always want to work with people who have been there and done it. You never want to be the guinea pig. I've tried that in my career. It almost always leads to bad experiences. So you want to work with larger managers, depending on the size of your asset. If you have something that's, a hundred to several hundred units, you want to work with a national firm. This is someone that has a large presence and track record across multiple states. Um, and in particular, you want to work with that firm that has a presence in your local community as well. And the reason why you want this is these national firms are going to have a lot of capabilities built up. They're going to have a great staff, not only on site, but supporting staff around it to generate marketing systems to train your on-site management and give them the most resources that they can to improve and provide value for your property. Um, Now, if you have a smaller property, let's say 100 units or less, sometimes the national firms aren't interested in that size asset, and so you want to look for strong local managers that have uh, high performance track record. So market specific strategy. This is oftentimes you're going to find managers that will come in and give you generic marketing plans. And they'll say, "Oh, well, I've been successful here. I've been successful here. Maybe I haven't managed in this market, but it's all kind of the same." Um, And I'm not saying you can't work with someone that hasn't managed in a specific market, but you want to make sure that they're taking a market specific approach to planning what they're going to do for your property because every market does act different. So you want when you're valuing managers, you want to make sure that they've done the work and research to understand your local market, everything that influences success there. And if they have a presence and track record of success in that local market, that is best. Marketing and lead generation capability. Again, this is why you want to work with the larger national firms if you can. They have a lot better marketing. They have a lot better lead gen capability. They know what works and what doesn't across thousands of units, and they can apply that experience to your property. And lastly, the most important thing in this whole process is going to be your on-site team. So this is going to be your property management, your leasing experts. These are the people that are interacting with your prospective tenants. They're the people that are managing who's on site working day to day, whether that be your maintenance contracts, fixing problems that come on site, all that. These are the people that make or break your community. If it's somebody that has low energy, that doesn't really care about their job, that's you're going to be able to tell that if you're a tenant that's coming and looking at the community. If it's somebody that's high energy, that loves what they're doing, that's excited and provides good customer service, that's somebody that's going to generate good reviews amongst your tenants. It's going to be somebody that's able to close on new prospective tenants. Uh, and it's somebody that's going to be able to work well with you in your oversight as the asset manager. So above all, knowing who your on-site team is and being able to evaluate them and vet them, that is the most important thing to get right. And when it comes to property management, as well as having somebody with integrity, because fraud more often than not occurs in this stage from those that are on site. So you want to make sure that whoever is on site, they have a lot of control and a lot of oversight. You want to make sure that there's somebody that has integrity and values the same things that you do. Some red flags here. We talked about generic marketing plans, high turnover, whether that be on site or with the property management. So if you have a management firm that is constantly switching out different employees and managers and regional managers, I've had that at times, and it becomes very difficult to keep managing and stay on top of things. A new regional manager might come over and they have different preferences and they aren't aware of the decisions you've already made and the things you've communicated, what you want done on that property. They start doing things differently. Um, it's just a lot of headache as opposed to having a company that values their employees and demands loyalty from those that are there. Those are the people that you want to work with long term. Overpromising. You don't want people to give you unrealistic expectations when they have no real expectation of being able to meet that. Those are people that'll give you these expectations to win the job and get you to sign a contract and then underperform on that. Little to no lease up experience. Again, you want somebody that knows what they're doing. Lease up, especially, is its own beast. Just because you're good at managing an older community or an affordable community or even a newer property that you've only been managing as it's been stabilized. Well, lease up is very different and requires different people to generate a lot of sales very quickly, as opposed to making sure that the properties run smoothly. So you want people with specific lease up experience. And then lack of systems, we talked about that, and lack of communication. You want good communicators. If you don't have good communication from your property manager, it can delay uh, communications that you have with potential future lenders or potential buyers that demand a lot of detailed, specific property information. Um, and it can also create issues with your reporting to investors, and you just don't want to get through that. I've had property managers that are poor communicators, and it's very frustrating. So let's talk about the role of the owner. This is, in other words, this is called the asset manager. So you have your property manager, which is usually a third party firm that you're going to hire to manage the property, but you are still the asset manager, which means that you are responsible for holding the property manager accountable. Now, some things that you really need to do, especially in the lease up stage, weekly KPI calls, KPI being key performance indicators. Now, this is important to have weekly during lease up. Once you're stabilized as a property, I usually recommend going monthly from that point. But during lease up, this is where the most action is happening. You need to understand what's being done on the property, how are tenants and prospective tenants reacting to your plan. You know, are you building momentum or is momentum stalled? The key thing is you need to keep momentum in this process of lease up. When momentum stalls, it's very hard to recover that. And so if you have to, bring in some more concessions, lower rents, whatever you need to do to keep that momentum going until you're full, that's what you got to do. You got to track the full funnel. So this is going to be traffic from your marketing efforts, how many of those convert into tours, which converts into applications, which converts into leases. If you have low conversion rates, something needs to change, whether that be your on-site staff. Maybe they're just not doing a good job of selling and converting on site. Maybe it's your pricing and your own expectations, and you need to adjust that. But there's something there that needs to change if you're not getting high conversion rates. Now, you're never going to close everybody that goes to the property, but you should be able to close at least 25 to 30% of those that come in and show up for a tour should be converting to applications, and applications to leases generally should be a pretty high conversion rate too. Some of them aren't going to be qualified, and that's okay, but generally it should be a pretty high conversion rate. You need to hold your staff and your manager accountable for poor performance. You want to have benefits if they exceed performance as well. You got to pick them up and let them know when they're winning that you're happy with what you're seeing. But when they're underperforming, there has to be consequences, and it's your job to set those expectations at the outset and to hold them accountable. Monthly financial reporting. This is critical. You do not want to be laxed in reviewing finances. Again, this is a stage where fraud can occur. And if you have people on site that uh, might be bad actors, you need to identify that early on. And so, reviewing the financials, how is that comparing with the budget? Is there anything that seems off or fishy there? A lot of times, high delinquencies can be just high delinquency, but it can also mean that there's something going on. And outside of just fraud, you want to be able to report to your investors and management, um, and those that have trusted you in this property of what's going on in that property and have transparency in that way. Oftentimes, a poor manager will deviate from the budget. They'll sign contracts and they'll do those things with the best intent, but they're not checking it against the budget. And if that happens, oftentimes you can overspend on a property when you don't have to. So it's your job to catch those things and to evaluate and to hold them accountable, and to make adjustments as you spot errors. And then ownership approval for budget variances. Sometimes you do have to vary from the budget, but it should never be varied from without your oversight. I'm going to stop here uh, and provide an opportunity for some questions, maybe one or two questions before we move on. Mike, it's good to see you, and Nicole too. What questions do any of you have?
Paul, one question that I was thinking about is I know you mentioned that momentum was important in the lease up. What do you find drives the most momentum?
That's a good question. There's a few things, and we might. Yeah, I think we'll talk about this on the next slide actually, but um, a lot of it is a balance. It's a balance of where are your rents at, where's the pricing at, what types of concessions do you have, and how desirable is your location. And it's adjusting those levers accordingly. But I'm gonna not go into detail on that just because that's the next slide that we're gonna be talking about.
Sounds good. Thanks.
Yep. Any other questions before we move on? Okay. All right, so lease up strategy. Now that we've talked a little bit about what makes a good manager, bad manager, how to navigate that process, how to select the right manager. Let's talk about strategies that work in lease up and maybe some that don't. So, first off is a balance of pricing versus absorption. And absorption basically is how quickly is your property filling up. Now, obviously, one of the key components to that is what's the price of the unit. And so you want to make sure that that you're not too aggressive on pricing. You're not too low, but you're also not too high because the higher you go on rents, obviously the lower conversion on leads. You're gonna have to work harder to get people to pay those higher prices. The lower you are on rents, you're gonna get a lot of traffic, but you're missing out on potential income. And you got to make sure that you're maximizing that because you have debts to pay, you have investors to provide returns for, etc. Um, so that's one of the levers is if you feel like there's no momentum on traffic and getting people to sign up for leases, one of the biggest things you can do is lower the price until that starts to happen. Now in lease up, this is different from long-term management. And long-term, you want to pay a lot more attention to yes, you want to stay full, but you also want to make sure you're maximizing price. And lease up, at least to start, you just need to get people on site. It's hard to show up at a property that's 300 units and for you to be the only car that's in the parking lot and to say, yes, I want to live here. People want to live in a place where there's a sense of community. So my strategy here is typically to start with, and still competitive, but at the lower end of the rent spectrum when you're starting to lease a property. And as you start to get 15, 20, 25% full, then you start to step up those rents. And as you're getting a little bit closer to 50%, 75%, each step of the way, you're stepping up rents, you're getting more aggressive until you find that balance of uh, of what people are willing to pay, but still move in at a quick rate. Then once you get closer to 85, 90%, that's where you really start to get to the top end of the market on rents. Um, and you can play around with that and as you see fit. But again, you want to prioritize momentum early on, and then you make adjustments later on to really find the best rent point for your community. Concessions, these should be used strategically. In today's market, you almost have to do concessions for lease up. I've had times back in 2017, 2018 where we didn't have to do concessions at all, and we were still leasing at 30 units a month. Now you have to put in concessions usually between 1 and 2 months free up front, and you're still leasing at about 12 to 15 units a month. That's just the reality of the market right now. But you don't want to be too strong on concessions unless you have to in order to create momentum. Because when a lender is looking at that as a potential refinance or a buyer is looking at that to buy, they're going to say, well, the rental rate might be good, but they also gave away 2 free months, and so the effective rental rate is much lower. And that's what I need to underwrite to for my next couple of years projections, which is going to be mean that I pay that person less for due to those expectations. So strong concessions, while it sounds good to get people in, and it sounds like, oh, well, I have to make a short-term sacrifice, but my rents are going to be higher still. Well, that's not necessarily how others are going to look at it when a lender or buyer is underwriting it. So be strategic about it. Don't go crazy with it, but it can be a great lever to help increase momentum. Then you want to create urgency. If you are offering a concession, or bonus or some sort of limited time or some sort of opportunity or deal for a prospective tenant. Forgive me as I'm stumbling over some of my words. You want to create urgency. So this isn't going to be something that's going to be available for forever. Like I said, as you generate momentum, you want to slowly take the foot off the gas as you get closer to full. And with these deals, you can generate momentum by saying, "Oh, this is an early bird discount." For example, if you're pre-leasing, the property hasn't opened yet. Those that sign today for the next 60 days until the property's open will get 6 weeks free of rent, and that can give a lot of early momentum of having a bunch of people ready to move in right away. But then once it opens, you take away that or reduce that concession to maybe zero or $500 free off rent for the first month. Um, And so it's creating incentive for people to act quickly. So that's another lever, and you can do that at different times. Maybe you do a winter special because winter is slower in the lease up period, etc. That can be a great lever to help generate momentum. Now, a key part of this whole thing is it's hard to get leases and to generate traffic if you're not marketing effectively. Some mistakes I see often is poor photos, which is funny because you think if you have a large apartment community that you have the budget to be able to uh, take photos, professional photos, but some of them don't. And so it's important to have high quality photos. This is going to be your first impression with prospective tenants. You want to make that a good impression. Don't shy away from budgeting for paid ads and special targeting. Again, momentum is more important and will be well worth the money spent as you try and get in front of as many eyeballs as possible to start off. Location is important. This is really something that leads to early acquisitions
Hey,
strategy.
Maria, how you doing?
Mike, you want to put that on mute? Thanks. Um, so location is something very important to evaluate early on in your acquisitions for the property, and it's going to help you with lease up. If you find something a property that's kind of off in the middle of nowhere, it's maybe set back from visibility from high traffic. Sometimes that can be hard to lease. You have to rely more heavily on your on other marketing tactics. Whereas if you have a property that's located right on a highway or interstate or right next to a major shopping center. You're going to get a lot of eyeballs. People are going to know that that property exists, and there's going to be desirability to live there because of that proximity. And so that's just going to help with foot traffic, banners from your property, and reduces your reliance on paid advertising and other tactics there. And lastly, you want people that have strong on-site experience working for you. These are going to be good sales staff, good customer service oriented people. The person that's on site is going to be able to convert all of this marketing. You want to have strong, uh, beautiful, attractive model units for people to be able to tour. That's usually something that converts really well, as well as having good amenities, things that people want to live in a community where it has those types of things. Now, some critical mistakes to avoid overpricing early. Again, you want to create momentum. So if you try and get the maximum rent possible from day one, you have 200 units to lease, well, that's going to create very slow momentum. It's important to fill it up first, and then you start to work on maximization over the next couple of years. So that's the strategy that we typically employ when it comes to pricing. In the long term, um, you want to be at the top of the market if you're the newest thing in the market. But in the short term, I want to start usually about the median as far as comparables. I want to be right about the 50th percentile on what's being charged for other comparable new apartments. And as you get closer to stabilization, I like to move that up to 60th percentile, 70th percentile, all the way up to about the 80th percentile is where I want to end up with on what I'm charging for rents. Okay, some risks to mitigate during this process. And lease up does carry risks. I mentioned this before, but this is a time period where it can be easy if you have a staff on site that doesn't share your values, isn't high in integrity. There are some fraud risks that show up during this time. Other risks that you'll see during the lease up period is overestimating demand. So if you have a property in an area that just doesn't have the demand, that's a risk. If you can't get a property full, you're not going to get the income. It's going to be hard to cover your debt service and to satisfy your investors' expectations. Construction delays. So if you start pre-leasing early on and say it's 60 days out and your construction gets delayed another 60 days. Well, now I have tenants that were committed to move in on a date that they can't move in anymore. And that creates canceled leases. It can create uh, a poor experience for prospective tenants, poor reviews. You might have to put them up in a hotel because they were planning on moving in a certain date. That just creates problems. And so make sure you're communicating well during this process with your general contractor to make sure that you have an identified and very achievable date for first move-ins to avoid uh, any such confusion. Uh, Poor early reviews is it's not the end of the world, but it can really negatively affect your property. You want to make sure that the people you hire on staff are customer service oriented. They're providing a great experience for your tenants. You want to provide a great product. Don't misrepresent the property on advertising. If it doesn't have, quartz countertops or stone countertops, don't make it feel like it does, right? So you want to represent it early and you want to do your best to solve problems. If a tenant comes to you and says, "Hey, I see this problem on the property," uh, be on top of that and treat them well, treat them with respect. That'll result in great reviews and it's going to create a great reputation for your property to bring in more traffic. We've talked pretty extensively about lack of early momentum and what to do to counteract that. But if you don't have good momentum early on, it's a massive risk as far as increased carry costs and the potential for uh, forcing poor decisions. So, for example, if it takes a lot longer to lease up, and I'm in my construction loan, and now I'm at the end of that construction loan, I have to pay it off, but I'm still 50% full. Well, I can't go get a long-term loan that's going to allow me to cash flow with an only 50% full property. So now I have to go get another bridge loan, which is more expensive, and I'm going to have to pay more fees and more interest to be able to get that done, which can be very costly for you and your investors. Operational risks. Again, we talked about the negatives of having a weak on-site team. That's a big risk if they're either lacking integrity or just not competent in what they're doing, or they don't take ownership and pride in what they're doing. Um, Again, every dollar that is either lost or gained on income means $20 in valuation that you're either gaining or losing on the site. And if you have someone that doesn't care enough to manage that dollar, you're going to see that NOI slippage and loss in valuation for your perspective for your property. Poor tenant screening, high delinquency and turnover is a killer in momentum. If you're filling people and bringing tenants in, but you're continually losing other tenants, it's really hard to overcome. So you want to make sure the standards are set and important and stuck to during this process. Expense creep, we talked about that just a second ago with that dollar lost is $20 in valuation lost. Again, it's your responsibility to oversee that, and it's your responsibility to make sure that you're on track with it and to manage as the asset manager, the property manager, in taking accountability for it. And then some financial risks. Excessive concessions can be very damaging long term for your property. So you want to accept concessions, but accept them within reason and strategically. There's a gap between underwriting and reality. And so you want to make sure that that gap is as small as possible. When you underwrite something, you want to make sure that you're being conservative in your underwriting so that you can achieve those things because that's the expectations that your lender's expecting, your investors are expecting. Um, and if you're too aggressive in that, then that creates a lot of issues with, your investors being upset and maybe not wanting to invest with you again, or your lender being upset and not working with you on needed extensions or other help. So it's important that you get those aligned, and when you're on the property, you're working proactively to be able to accomplish what your underlying expectations were. Now, some mitigation here. Again, pre-leasing early is good as long as you're in line with your construction general contractor on what that date is. But if you pre-lease and you're offering these specials, you're getting momentum. If you have, 20, 30 people that are ready to move in day one, well, now all of a sudden there's a bunch of cars in the parking lot. There's momentum. People, when they visit this property, see that other people want to move there. It just creates this energy that's contagious. That's what you want for your property, especially early on. And that, when planned properly, can help reduce the demand concerns. It can give you great reviews early on if you're able to manage that process well, etc. Um, Control property and reputation. Again, approaching things with a customer service mindset is really what you want your staff to be doing. You got to create a good experience for those that are on there. And as they give good reviews, they talk to their friends about it. That's going to be very valuable in the long. Now let's go ahead and move on to our last slide. This is going to be discussing long-term management. Long-term management is very different from lease-up strategy. Once lease up is all about getting full, maximizing momentum, uh, and getting a property to where it's stabilized. So that's the focus of lease up. Long-term management is very different. Now that you have a full property, I can start to be a lot more strategic and careful about the tenants I'm replacing, because I'm doing so at a lower rate, right? Now, you want to retain as many tenants as you possibly can. Oftentimes that'll include special deals for them. If rents have increased 10%, maybe you're only going to increase their contract 5%, right? And add in some other incentives to keep them there because low turnover is valuable for a property. However, if some of the early tenants that you had in, uh, you offered great low rents and now your rents are 10 to 15 to 20% higher than when you started, this is an opportunity for you to start replacing these older, cheaper rent tenants with newer tenants that are willing to pay a lot more. And this is where you start to maximize your NOI. And when in this process with long-term management, you're trying to maximize the rents that you're receiving from tenants. Every time you renew a contract or replace a contract, you're trying to improve upon the value that was there before. And while you're improving upon income there, you're also identifying, maybe trying to fill up any carports that you were unable to fill the first time around, or garages, or storage units, etc. And so you're continuing to generate more income with that. And at the same time, you're trying to get more efficient on the expenses. So if you have an insurance contract that you can improve upon, or you have a lawn care contract that you can save an extra $1,000 a month on. This is that time where you start to increase your income, try to get more efficient and decrease where you can the expenses, which all turns into increased NOI, which allows you to set yourself up for either maximized distributions to your investors or to you if you own this outright, or it maximizes your valuation for a potential sale and to get the most profits possible. This is a very underrated time for these properties, but there's a lot you can do to maximize that NOI and set yourself up for long-term profits and success. Um, key metrics to look at during this time is renewal rates. So how many people, when their contract expires, are choosing to renew that? If you have a very low renewal rate, then that's an indication that people are not happy with how the property is being run. Oftentimes that can start to show in poor reviews, etc. Or sometimes that's going to happen just because, especially the first year or so, as you're replacing cheap, lower rents that you did during lease up and getting higher, sometimes you're just not going to be able to retain as many people. But you do want to watch that and you want to evaluate this so that you can retain as many tenants as possible year over year. Turn costs, again, as you do have to renew and replace new tenants, you have to make that new unit ready as if it were new or is in good condition. And that can be very costly. You want to make sure you're doing what you can to be able to reduce that. Oftentimes that can be reduced with on-time or on-site staff that's responsible for that as opposed to subbing it out, etc. Effective rate versus market. So you want to constantly be comparing where are your rents versus the market rents. If you see the market is increasing, but your rents are staying the same, well, you're missing out a lot of opportunity to increase with the market. Similarly, if you see the market is decreasing and your rents are the same and your turnover is starting to, or your renewal rates are starting to get really low, that's an indication that you should be adjusting rates accordingly to be able to uh, keep full. Again, the value drivers here are going to be the two things that I just mentioned. Rent increases plus operational efficiency, expense management is going to be able to give you the most value in the long term, and that's what this game is all about. So with that, any questions on anything that we've talked about in today's webinar?
One question I had, Paul, was balancing the whole idea of I guess concessions versus lower rents. What do you I guess what balance do you try to achieve there?
Yeah. Yeah, because you don't want one, like, for example, you don't want concessions to be ultra high. And you just don't want to be on the extremes of either rents or concessions. And so the levers here of do I increase the concessions and make it extremely aggressive to make people want to come in? Well, if you're renting at $1,000 a month, but your concessions are 2 months free, well, during that year that you're living there, your contract might be to pay $12,000, so $1,000 per month. But if you're 2 months free, really what you're doing is paying $10,000. And most people are going to underwrite that as saying, well, their contract was not $1,000 a month. It was whatever the math is on that $800 a month, or et cetera. So you don't want to be too extreme on one way or the other. You want to find a balance of medium concessions. So, if your lease up, usually 1 month to 6 weeks free is going to be that sweet spot, especially early on, and then you burn that off over time as you get more full. But the rents you want to be in line with your market rents. You don't want to be in the 30th or 40th percentile. You want to be about in the 50th percentile to start to say, hey, I can command the rents that everybody else is commanding. But because you're a brand new property, usually with newer units, better amenities, etc., you can start to creep up and end up in that 70th to 80th percentile on rents when you're in the 90 to 95% occupancy as you burn off concessions. And so starting off at the 20th percentile rents in your market, that's too low on rents. So maybe you need to be at the 50th or 60th percentile on the market, but add in some concessions there to compete with your lower renting units to get people to move in quicker. That's a good thing. You just don't want to get too overboard on either one. I don't know if that answered your question, but
No, I think it does. I feel like I'm a numbers guy, so whenever you say 50th percentile, that makes a lot of sense that you start there and then adjust.
yeah. Great. Any other questions before we wrap up today's webinar? Okay. Well, for those viewing, I know we've got a few here on the Zoom link, and to those viewing via LinkedIn Live, we sure appreciate you participating. I hope this has been valuable, and some of the insights that we've had to share. If you did find value in it, we encourage you to participate in our next webinar. So on May 5th, that's Tuesday at 12:30 p.m., we're going to be doing another webinar, how investors get paid in real estate development. So this is essentially going to be from an investor's perspective. What are the points that you expect to receive money distributions throughout the whole process, whether that's during construction, during lease up, at a sale, continued management, etc. So we'll be breaking that down May 5th. That's a Tuesday at 12:30 p.m. Mountain Time. And then after that, 2 weeks from that point, we're going to do another webinar, which is the sponsor playbook. So this is how to identify and vet who you want to invest with, who you should trust with your money. Now, if you would like to learn more about opportunities to work with us long term, we invite you to scan this QR code here, book a call with me. We'd love to speak with you about what that looks like. Other than that, we appreciate your attendance here. And again, hope you found some value in what we've had to offer. Hope you all have a wonderful day.
Thanks.
Good stuff, Paul. Thanks.
Thanks, Mike.
Thank you.